The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, everybody. Welcome to the Mid-Michigan Roundtable. We do this as a joint program with Manifest Investing. My name is Ken Kavula. I'm the board member with the Mid-Michigan chapter, and joining us this evening will be Kim Butcher from Southern Indiana, Hugh McManus from out in Orange County, Pasadena, California, that general area, and Mark Robertson from just about 45 minutes south of where I'm living in mid-Michigan. Mark lives in Rochester Hills. One of our knights, Cy Lynch, will not be able to be with us this evening. We're going to miss him, but we will soldier on, make things work here. Mark, were you able to find Kim and get her into the back room?
I can do that. Greetings,
Okay,
everybody. I'm going to leave the recording going, Ken, because we left it going on start. So, everybody, what you're hearing, this is the people milling into the room session of the known as the green room, where we will talk about topics. Ken will be talking to you about your audio stuff, but I'll go and see if I can find Kim.
Okay, I've got her in the back room now, Mark, so we should be all set.
Okay.
And Hugh is actually with us too. Hugh, can you hear us okay?
Yeah, I can hear you. Can everyone hear me?
And we can hear you loudly and clearly. Sounds real good. Sounds excellent, okay? We have a number of folks in the room waiting for us to begin. We will begin promptly at 8:30 Eastern Time. Meanwhile, if you'd like to test your audio, if you're the kind of person that wants to talk out loud, we'd be glad to have you speak with us. Just raise your hand. There's a hand icon. Let's see if I can get that icon to show. It's there, okay. And if you want to speak or just test your equipment, you can do that. But we also have the ability to talk with you by text. There's a questions box on your control panel, and you can type in a comment or a question or an answer to a question if we've asked something and we don't know the answer to it. So this is pretty interactive and pretty informal. So become part of the program by participating. Meanwhile,
fellow knights in the audience. Nick is out there, so is Herb.
Oh my goodness. Okay. Well, meanwhile, we're in the middle of a real heat wave here, but we're going to have rain again tonight. Mark, did you have heavy duty rain last night?
We had a little bit. The kids are up at Burt Lake, and they got completely hammered. They were out of power up there.
We got away with just about 2 inches of rain, but north of us, we had most of the Saginaw County area losing power also. So we had some pretty decent storms north of us, all the way up to the Traverse City area. So we're hoping tonight it's just a little bit of a rain kind of a thing. I don't need my dog getting me up at 2 in the morning again with telling me that there's thunder outside. So.
Yeah, I'll bet Hugh McManus has trouble when his puppies lay on his feet during a storm.
Yeah, certainly do. Oh, they've recently learned how to jump, which is scary.
Oh no! Considering his puppies are about as big as he is.
Well, my puppy's a dachshund, Hugh, so she jumps, but she doesn't jump very high. So she's more into wiggling than jumping. So. It's a nice size audience for this with this much time left here. So Kim, are you in Florida right now or are you back in Indiana?
Oh, I'm in Florida. I'll probably be here for a while.
Still in Florida, okay.
We had lots of rain today. I think we had 3 different rain showers that lasted like an hour each time. So just must be the whole country.
Herb, I see your hand in the air, so I'm going to unmute you. Go on, Herb.
Yeah, one of the companies I've been following is into the par of negative 3.7, which is Aero Environmental. I'm wondering if anybody else has had that stock and what are they thinking about doing with that? It's like, Mark, maybe you haven't updated something because they're beating estimates by like 18% and they're just doing really good.
Are you talking about AVAV? Is that the ticker symbol, Herb?
Yeah.
Okay, I'm very familiar with the company also, but that par on Manifest for AeroVironment, that par on Manifest is pretty close to the par on my SSG. I'm kind of in agreement with it.
They are due for an update though, and that is something to watch because some of these companies are just catching up with improvements or ramping up of production and a variety of things. But this company has been on quite a run in the last year, as you can see on the chart. In the last 12 months, it's gone up quite a bit.
I've been a little concerned. I hold this in one portfolio, and I've been a little bit concerned. If you could leave that chronicle up there, Mark, with the
I'll be back to
downturn, with the downturn in quality on this company. It seems to be ramping down in a fairly orderly manner, but it does seem to be definitely in a downward trend. That bothers me a little bit with this company, and it's on my list of chopping block candidates when I do some rebalancing at the end of this month. So I've made it's been good to me. It's been real good to me, but I'm concerned by this negative sloping line going back to about 2016.
Yeah, and if you recall, Hugh actually had some commentary on this one about 4 years ago on inventory challenges and that sort of stuff. Hugh, do you continue to follow the company at all?
Yeah, I do, and yeah, it's going through quite an amazing growth spurt right now. I haven't looked at it in a number of months, but I'm now motivated to get back and look again. Because if you recall, before we were looking at inventories, and it seemed to suggest that good times were ahead. They were at least bulking up for sales. But yeah, it's been, as you say, on a tear recently.
Yeah, I've just Herb, I've just pulled up my own SSG on AVAV, and my own SSG is only showing a 1.5% par. I didn't compare it to Mark's number for number, but when I'm at just barely positive and he's just a little bit negative, in my mind, that's basically telling us the same thing about the company, that it might very well be a candidate for a sale. And I do not regard AVAV as a core holding in my portfolio, at least. I bought it because I felt it's in the, for those of you that don't know, it makes drones, and it also has some exposure to the electric car industry by making charging stations for electric cars. But I've never felt that it was a core holding from the time that I bought it. But it's always treated me quite well as far as the cash is concerned. So
we're going to be talking here in a few minutes about how Ken just a couple of weeks ago recommended that we hold on and watch Cambrix for an update in case there was more strength coming. And that's the same type of thing I would do here. I would compare the expectations we had versus what is on the screen now at Yahoo Finance, and you can see they're certainly not. They're pretty robust, and it'll be interesting to see how those compare. And as the next value line update is 1 week out, so it might be interesting to see how if that actually gives it a boost at all to maybe take it out of negative. But in any event, depending on the portfolio, got to be one of the lower return forecasts in virtually anybody's portfolio.
Yeah, Herb, you have 1 minute before we have an official start. Your hand's up again, so go on.
Oh, I'm sorry, I didn't mean to leave it. I shouldn't have. Sorry about that.
Okay, I'm gonna unmute you. I'm gonna mute you again so we can start right here. I got a few questions in the questions box. Let's see if I can read what they are. We're getting just a very nice compliment from Ann Manning down in Texas, where she says that she missed the Turnout Tuesday for August, watched us on YouTube, however. Thanks for the great presentation. I'm really pleasantly surprised by the number of hits that our roundtables and that our YouTubes get, or that our turnouts get on the YouTube channel. I never in a million years thought I'd have something on YouTube that had a couple hundred hits, and a lot of these things have a couple hundred hits. So
I think I'll say ditto to you, Ken.
yeah.
And then my 28-year-old son will look at that and says, that many people will watch that sort of stuff?
Mark, I'm looking at my watch and we're right on time. So if you want to start everything off, feel free.
All right. Well, I'll go ahead and kick things off and we'll see how we can go. Well, welcome everybody to the August simmering, steaming session of the Roundtable for August 2018. We're going to be talking about some fairly interesting stuff tonight, including some additional and I would say fairly assertive, and I'm sugarcoating, portfolio stuff here in a few minutes. Again, coalescing some of the stuff we've been talking about with respect to better selling, and I think we'll have a little bit of fun with that, and we'll also have our traditional stock presentations. We are joined here tonight by Kim Butcher. Kim is a retired healthcare professional out of Evansville, Indiana, who is spending a fair amount of time taking care of family down in Florida, and she's been quite the accomplished stock picker here for us over the last several years, and we welcome you back to the Roundtable as our guest damsel for the night. Kim, welcome. She's probably remuted.
Yeah, well, I unmuted. Thank you.
Well, welcome back. And my treasured friend Ken Kavula to the north. He lives about a half hour north of me, but Ken is known nationwide for his educational sessions. He's spent a lifetime educating your children, and he continues to spend time sharing stories and encouraging investors to be better from one coast to the other, and we greatly appreciate your efforts too, Ken.
Thanks, Mark.
And Mr. McManus is here with us, so welcome back, Hugh, and we're glad that your travel schedule allowed you to be with us here tonight. You certainly have a phenomenal track record with the Roundtable also, and we appreciate all of your contributions. We'll be listening for those Irish wolfhounds tonight.
Oh, you'll hear them. Thanks.
All right, and my name is Mark Robertson. I am founder and managing partner of Manifest Investing. We are proud and just pleased beyond all measure to co-sponsor these presentations with a chapter of the Better Investing Organization, the umbrella organization for investment clubs and champions of the modern investment club movement. And we just love doing all the stuff that we do with volunteers nationwide. So let's go ahead and get underway. Quick bit of housekeeping. This is about a philosophy, a process, methods used by the modern investment club movement, either through Better Investing or Manifest Investing. We follow the lessons and the legends of successful investing over these past 70 plus years. So it is a demonstration. No investment recommendation whatsoever is intended. Please do your own homework. If you'd like to either add yourself to an email reminder list about our educational sessions, the roundtables and the Turnout Tuesdays that we do, or if you have a friend or family member that you think should experience it, please consider sending an email to nkavula1@comcast.net. That's nkavula1@comcast.net. And Natalie, Ken's a significant better half, will be happy to add you to that list. She will not inundate you with email, but she will help you remember when the sessions are going on. If you'd like a copy of the slides, or if you have a Q&A that you would like to address to any of us, you can send it to mark@manifestinvesting.com, and we'll do our best to answer that. Anything else you'd like to add there, Ken?
No, Natalie got a lot of, people, I guess, asking her to be added after your trip to Atlanta, after my trip to Oklahoma City. So we welcome those of you from Oklahoma City and from Atlanta that are new here tonight. And we hope you like what you hear, and we hope you come back for other roundtables. Very
true. And we should also point out that the sessions are archived 99% of the time on YouTube. If you go to YouTube and search Roundtable, Manifest Investing, just those type of words, you will find a collection of the archived videos. Here's a quick look at our agenda. It's a standing agenda that we pretty much go through every month. Again, welcome to all of you, as Ken just did, especially big welcome for the newcomers. We do talk about the performance achieved over these last 8+ years. We are going to continue our discussion of better selling, and then we're going to talk about this notion of the challenge concept when it comes to portfolio management, tackling the positions that the tracking portfolio for the roundtable has in Robert Half, Polaris, and then a roster of companies that have just not behaved very well since the decisions to pick them up were made. Our stock selections are, as you can see there. Kim is going to cover Wyndham Hotels. Ken is IPG Photonics. I've got LCII Industries, and he was unable because of his work schedule to put anything together, but he may have some cheap seat commentary for all of us that we welcome with widely open arms. We run an audience poll after the 3 stock presentations. Then we typically will leave the floor open for Q&A for as long as you guys have Q&A. All right, just a quick summary of what we're doing here, what this is all about. We've been doing this now for more than 8 years, coming together to share an idea. It's generally going to be one of our better actionable investment opportunities. And when we say actionable, we mean suitable for further study and consideration. We do have some non-core selections that we tolerate, but our long-term goal is to basically beat the market by 5 percentage points. That's 500 basis points for those of you who speak that language. We measure the market by the Wilshire 5000. We keep track of every decision made versus that Wilshire 5000. We'd like to see a majority of those selections actually beating the market over time. Real quickly, I may be running through these a little bit quick for some of you, but I'm trying to get through this stuff because we've got quite a bit of stuff to tackle here tonight, some really good stuff. This is a good story, folks. Again, almost 8 years. The internal rate of return since inception is almost 19% now at 18.8%. The Wilshire 5000, if you had taken and invested each one of those decisions into the Wilshire 5000, that return would be 13.5. That adds up to a relative return of 5.3%. That dotted line across the chart is the basic objective that most investment clubs shoot for. That is to beat the overall stock market by 5 percentage points over the long term. And again, if you're in the 0 to 2% range, you're doing well. If you're in the 2 to 5, you're doing really well. And you start getting above that line, you're in kind of rarefied company. Thanks to the heat of the market here over the last couple of months and all of the stuff going on, we actually have dipped below 50% on selection accuracy for the first time in quite a long time. Again, we'd like to see that number up around 60 also. Any comments or questions, Ken?
I just say hooray and a big round of applause for all the folks that have picked stocks that go into this portfolio. It's been a 8-year battle to keep that line up there to that dotted line, and we've managed to do it for about a year now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 dots above that thing. That's pretty good, Mark.
It's been pretty hard to stay ahead of the market here over the last few months. I don't know if you guys have noticed, but our rate of return, and again, that's annualized since inception, has been creeping up and up, but the market has been chasing us like an overly assertive Irish wolfhound. All right, let me take just a quick look at the portfolio and keep us rolling here. These are the actual positions in the tracking portfolio. You can actually look at I believe there's about 80, maybe 90 positions in the portfolio. You can see them at that public link at the top of the page, manifestinvesting.com/dashboards/public/roundtable. And what you'll find is the full list. These are the top 20. What we do is we take and invest $1,000 into any decision that is made, whether it's made by a knight, a damsel, or the audience. And then that legend up at the top between the link box and the portfolio dashboard that's on display here is the number of times something has been selected. So in the case of Cognizant Technology, it's been selected 15 times. So $15,000 invested is now worth nearly $27,000. So you can basically go down that key, find the company, and see how many times it was selected And some of them are a lot of fun because they haven't been selected very many times, yet they're on this list. Case in point, Amazon. Selected, I believe, twice. Did we get up to 3 times? No, that's twice. $2,000 invested in Amazon, thanks to Mr. McManus, is now worth $13,159. As you can see right here. Anything else jump off the table at this point to anybody in the room?
Mark, I really like to see at the top of the list 5 or 6 stocks that you really know their names of, and then 2 or 3 that you scratch your head and you say, what the heck is that company? Because when you can find a what the heck is that company among your top 10, then you've made a pretty good killing. I draw your attention to Universal Display, OLED. I think that's a 5-time selection, so that means $10,000 dropped into it. I'm sorry, that means $5,000 dropped into it, and it's worth $18,000 today. So those kind of things, when you can scratch your head and not quite sure what that company is, that's a really good thing. I noticed Illumina on the list, another one, Maximus, that they're not really well-known stocks outside of our community, and even within our community, they're not well-known. They're not known to a great degree.
And one of my favorites, and Kim, stop me if I'm wrong, but PayPal. A lot of people scratched their head when Kim brought PayPal as a spinoff years ago from eBay, and it's gone from 4 to almost 8,000. And another one of her spinoffs, S&P Global, makes this list also.
Cha-ching, cha-ching. I like my spinoffs.
Yep, they're working out. And again, thanks you for Amazon. We love you, man.
Well, and for Bank of America, Mark.
Yeah, I don't like to talk about Bank of America because I listened to him for so long, and he tried to talk me into buying some. Tried to talk a lot of people into buying some.
Yeah, well, the news was bad then. Booking is a company I've been digging into recently too. I wasn't super familiar with it,
Yeah, it's going to show up tonight. Obviously that's been what is that? It's up to a 10-time selection by us. It's actually down a little bit, and it's actually
that's Priceline before the name change, isn't it?
Yeah.
Yeah, so it's actually wandering near the buy zone, I think. All right, so let's go ahead and talk a little bit about this topic of, we're going to get to this notion of a challenge, but this selling discipline we've talked about a little bit. And I threw this slide together. Please jump in, any of you guys, as we go through this. But Ken and I have been talking about for months now this notion of selling better, and make the portfolio better. And I love that road sign, better than before. Start your effort, treat it like a marathon. It's a long distance journey. Think of it almost as marching to a cadence, but steadily keep making it better, and better in terms of enough return, enough quality, much like that definition says there, and enough growth. And that's kind of my hot button. I will be talking a little bit more about that tonight, but this notion of also noticing that the most frequent decision for selling a stock within a portfolio should be based on impact on the total portfolio, but it should be this condition of handing off the baton. We're going to talk in a minute here about Robert Half and how it's just time for Robert Half to hand the baton to somebody else, and it's a wonderful thing when it happens. And we're also going to talk about this rule of 5 notion of when a company just misbehaves pretty dramatically, and sometimes you just have to call a timeout on companies to protect overall capital. And then, as we've been talking the last couple of months, this notion of quality degradation, and when the quality starts to dip and dive from being in the 90s to below the 80 threshold for excellent companies, and then it just continues down. Sometimes you just have to admit that we try to avoid being stubborn, and you just have to let them go. Any comment on just these overall notions of reasons for selling? And then we're going to walk through current case studies with the tracking portfolio. It's going to demonstrate all of these conditions.
Well, we challenge the audience right now to tell us what company's quality graph that is. We'll get to it in 5 or 6 slides, but a nice challenge to you out there. What company is that we're looking at on this quality graph?
I know the answer. I'm not allowed to answer, right?
You're not allowed to answer, Mark. No.
Okay, thank you. I never know because, you'll wait for an answer. But yeah, think about it. No matter what company it is, how would you feel about it? And not only that, think about it in terms of no matter what company it is, what you're looking at is not fiction and it's not emotion, at least not much. Because what you're literally witnessing is something going on with a company where it's either growing slower, becoming less profitable compared to its peers, getting more erratic with respect to what it earns, or perhaps the balance sheet is suffering some form of damage. And that's typically, and it's covered there by the definition, it could be a turnaround situation, could have illness, injury, or mental stress, being less unwell. So again, those type of situations can be very destructive to holding with.
Does it run on batteries?
Was that a guess?
Yeah. It's not Tesla, is it?
No, it's not Tesla.
Oh.
It'll come up in a minute.
Okay.
We'll keep you all hanging.
Oh, it's not GE.
We'll keep you all hanging.
Okay, well, Mark, just give me a second, okay? Joe Murphy, it's not IPGP. Bonnie, it's not Berkshire Hathaway. Sandy, it's not CMG. It's not Saracycle Brews. And we have a number of our folks that are guessing yes, so you can celebrate if you sent me a guess and I didn't tell you it wasn't that company, but we're going to kind of keep it secret for just a little bit more yet, okay?
I think
we have 1, 2, 3, 4, 5, 6, 7 folks that guessed it, Mark.
They guessed it right?
You guessed it right, uh-huh.
Okay. I think Chipotle is a wonderful guess, by the way.
Yeah.
All right, we'll keep pressing on. All right, so let's first talk about that handing off of the baton. And Ken, why don't you kind of take this one away? What you're looking at here is the portfolio sorted from lowest return to highest return. So this is the challenge concept in our interpretation. Robert Half has been a wonderful situation. Go ahead, Ken. What are your thoughts on this situation when looking at this?
I brought Robert Half to this portfolio. Robert Half is a staffing organization, a temporary staffing organization that provides substitutes and long-term subs for skilled workers, accountants, and the equivalent type of skill levels. I brought it to the attention of the roundtable, I don't know, 2 years ago, 3 years ago. It's treated us well. Its value is now $4,000 plus dollars, but I don't consider Robert Half a core holding. I never have, and we've always tried to talk ourselves into getting rid of non-core holdings as they move below average and as they start to approach 0, 1, 2% par. This one's sitting at the lowest par in the active part of the portfolio. So I don't see any problems at all with saying thank you, Robert Half, for the money you've given us and moving it out of the portfolio at this time. The one thing I would like to check, and I know Mark has checked it already, but the one thing that I would urge you to do is the same thing we did on Cambridge last month. We noticed that the Cambridge data was coming up near the end of the 3-month cycle. The manifest cycle is that a stock gets updated at least every 3 months. And we noticed that the date for the Cambridge update was very close to a date after the last roundtable. So Cambridge was at the bottom of the list, and after the update, Cambridge has moved back to somewhere close to the average now for the stock market. We've been measuring averages at about 6.5 to 7.5 over the last couple of months. And so 5 is an okay stock to hold. This is a very nice small stock. I would urge you to take a look at it, not anywhere near the buy zone, but I don't think it's anywhere near the get rid of it zone because it's outperformed either. I would make sure that Robert Half does not have data that, excuse me, that needs updating real quickly. But other than that, Mark's pointing to the relative strength graph. And, when it moves above 70, like we're looking at right now, that's another indicator it might be oversold. No, overbought.
Yeah, it's a little bit pricey.
Yeah, well, it's pricey. Yeah, that's a better way for me to say it. Yeah.
You can actually see the transactions are listed in that ledger up at the top. This is that spreadsheet, that relative return spreadsheet that we've talked about. So June 28th, a couple of years ago, a little over 2 years ago. So it's actually gone up $1,300 a piece. So Ken and the audience have added $2,600 to the portfolio. And the annualized relative return is actually 26.5. That probably puts it pretty close to the all-time leaderboard. And this is just confirming that, yeah, it's had a pretty rapid, hard run up. And one thing I would draw the audience's attention to is, when it hits this condition, you can very often get a situation where it'll stagnate and basically plateau for quite a while. That's also something that can happen. So we could see a plateau out of Robert Half. Here's a quick audit that Ken was just mentioning to make sure that the information is relatively current and that we are looking at low single digits on it as we pass that baton and thank it most graciously for helping the portfolio, but pass the baton and continue the race. Any questions on that, Ken, or anything that would be dramatically different?
Mark, I still hold Robert Half, and I want to say that it's facing some real stiff upward competition right now, not in competition from another company, but in competition for people to fill the spots that it in turn wants to help other companies fill. In other words, Robert Half is having a hard time finding people to staff its own legions with, so that it can then turn around and offer these people as substitutes to other businesses. There's a real labor shortage, and the more skilled the labor, the more the shortage seems to be affecting what's going on right now.
Hugh, do you continue to see that same condition in your travels in the pharmacy world?
Oh yeah, there's no question. I mean, pharmaceutical companies, particularly in the Bay Area, have hundreds and hundreds of open positions, particularly in analytical chemistry. It's kind of curious because you compare that with the big guys. Eli Lilly will be doing another round of layoffs soon. So the big guys are a little bit different.
Mark, my brother-in-law was a vice president for BASF. It's a German chemical company with some plants here in the United States. He ran their research chemistry laboratory arm for BASF. And he just told me when we visited just a couple of weeks ago that right now that research chemistry lab, which is in Tarrytown, New York, is missing about 15 to 20% of its employees. They can't fill the spots for those employees.
Wow, it's just amazing that we've come to this point, and Hugh has seen it for a few years coming. It's something else. So I guess we'll go ahead and thank Robert Half and give them a time out to breathe a little bit. All right, the second case that we've talked about here over the last several months is that situation where we just have to admit that every once in a while we're stubborn, and got to try to find a pill for an anti-stubborn pill. And we believe that pill might be tracking the performance of the investment relative to the stock market. And again, we really see this as an incarnation of the Rule of Five, where, again, no matter how well you do a stock study, regular attendees of the roundtable will remember my fantastic, fabulous selection of Iconics brand that didn't work out very well. It's just going to happen. You just have to admit that it's going to happen, and that's what we're talking about. At the Turnout Tuesday a few weeks ago, Ken demonstrated how we can actually track the relative return using graphical devices. This happens to be stock charts where you enter the ticker symbol, comma, and then the benchmark. In this case, you see it's BTI. That's the Wilshire 5000 ETF. So we're comparing the performance of Neogen in this case versus the Wilshire 5000, and you can see that it's consistently stayed ahead of the market. The market is the blue line again. The Wilshire 5000 is this blue line. Neogen is the black line. So again, you can do it by entering the start date of the decision, tracking it up through today, and basically look at it graphically. Here's another example of one where from the Fave 5 tracking portfolio that we do at Manifest Investing, where the company was selected, did phenomenally well for a few months, and then hit one heck of a speed bump after Thanksgiving back in 2017, triggered the minus 20%, alpha at minus 20%. That meant that at that point, Amira Natural Foods was lagging the market by 20%, so we walked away from it and basically avoided the losses seen to the right-hand side of that red arrow. So that's the type of concept, the protective measure that we think might be in place for some of our holdings. As some of you know from our presentations on Iconics brand, we walked away from that $1,000 investment in Iconics with our $800 intact. The last time I checked, the Iconics is now worth $14. So we'd be down to $14 from the original 1,000. So it can be a very protective thing. Here's a graphical, beyond the graphical representation, here's the raw math for selections that fall beneath the minus 20 relative return criteria for the roundtable tracking portfolio. And most of us have a stock on there or two. And General Electric has just been a train wreck. I agree with the premise of everything that was done with GE, and by the way, that does show the chronicle at the bottom. That is the GE quality EKG falling apart on the right-hand side. They're just going through a massive turnaround attempt, and you can see that the individual positions have suffered greatly. I don't know. I tend to think of GE as really being stuck in the middle of a very challenging turnaround, probably facing a condition known as dead money in the investment industry while everybody proceeds to loathe it for the next couple of years. Any thoughts on the situation, Hugh? Or
Well, it's definitely getting punished. I mean, getting kicked out of the Dow is something. Slash, lack of security in the dividend, frightening. So it's definitely getting punished. It is honestly one of these things that I simply hold on to. The only way you really continue at a loss is you actually sell at a lower price than you bought. It's something that I rail against. But I mean, this company has such a history of experience. Everything comes to an end, right? But I'm not convinced that this is the end of GE right now. It's a company with a lot of experience, and my thought is that it has the firepower to right itself if it has selected the right industries in which it wants to concentrate. And with the addition of healthcare, the emphasis there, it seems to be a good move.
Yeah, I would second that. I mean, I was worked as a competitor to General Electric. They ultimately ended up buying my company, so I'm alumni by acquisition now. I watched them as a formidable competitor. I watched some of the moves that were a bit of head-scratching moves along the way, but the pieces that are still there, their jet engines, the various businesses that they're still in, they are quite, we're talking world-class skilled at them. So the remnants of what is left does have a lot of potential. I'm with you. For some of the longer-term portfolios that we have personally, we probably hang on and even look to accumulate, believe it or not, but I will not break my rule of waiting for that quality trend to inflect and head back upward for a while. They really have to catch themselves and stick the landing a little bit, and they're not really doing that yet.
And the same with Ardelyx, which I see is on the list, one of my picks. This is a clinical stage biotech company, small molecule, and these share prices tend to be incredibly volatile, and good and bad news has tremendous leverage on the stock price. And it's gone through a down phase right now, but the company has a lot of cash. It's motoring along nicely. It's something that I certainly wouldn't sell at this point.
Any thoughts?
I'm sorry I didn't buy it at this point. Instead of a 1091, but there you go.
Any thoughts, Ken?
Well, I'm grappling with a couple of ideas, and we spoke before the session started. I see we have two Starbucks holdings on the list here, and we've actually picked Starbucks 5 or 6 times. All 6 of the holdings are in negative relative return, and I'm wondering if we should be selling all 6, not just the 2 that are more than 20% off. The same thing about CVS. There's a CVS holding on this list. It's down at negative 25, but we have 8 or 9 other CVS picks that we've made over the 8 years, and they're all in negative relative return as well. I'm going to defer to my partner right now that is saying we're doing some testing of some ideas, and to test the ideas, we can't test, I'm enough of a scientist to understand that we can't test 50 different variables all at once. We have to kind of keep the variables relatively simple to see if our test is really working out. So if you're going to pull the trigger on this list, Mark, the only one that I would ask you to keep off the trigger list is that one holding of Priceline, that Booking.com holding right there. I think that's an overreaction to a recent earnings call, and I don't see any reason to pull the trigger on that one. But I'll take the pain and everything else that goes with undoing the list, and it'll give us a lot more data so that a year or 2 years from now we'll be able to see whether this trigger that we've been talking about so much is really an effective way to help us manage a portfolio.
Now, I would go one step further and agree with Hugh on Ardelyx. I agree. It'd be really nice to have bought it at 440. Maybe we double down tonight. Who knows? But Ardelyx actually shows up on one of Chris Jenner's. He runs Rock Springs Capital Management. He's the former manager of the T. Rowe Price Health Sciences, world-beating mutual fund. And Ardelyx is one of his top picks right now. So I have a hard time with. And he's fully aware of the volatility too, and I'm just moved by. I know Hugh's perspective is so long term, so is Chris Jenner's. The people we watch at Brown Small Capital Management, I watched them hang on to Zoe's Kitchen when it dropped from 16 down to like 6, and they hung in there, and it looks like it's going to be taken out at $14 or $15 private. So it actually jumped up quite a bit here recently. Sometimes you do have to weather these storms. But by the same token, I think we should probably pursue the implementation. And as far as the partial sales, I really got to wonder. In the case of a Starbucks, it's probably in the buy zone. We've picked it, like you said, 5 or 6 times. Maybe this is like a partial antidote or a partial recipe for being a little bit stubborn. There's a lot of danger in that, but literally we could be talking about selling 2 of the Starbucks positions while holding on to the 3 or 4 that are out there, and we're literally reducing the position in terms of the total number of positions. But following these rules, we just watch and see how it works out.
Well, and we've also said that we're searching for what number makes a lot of sense, and we've settled on the number 20% or less in relative return as the trigger. Maybe that number is 22 or 25 or 18. We don't know yet. And until we do some testing and set some experiments and see what happens, a year down the road, 2 years down the road, and then compare to what we would have been if we wouldn't have pulled the trigger, we might as well start the discipline and see what happens with it. We have some good data already, and this will give us a lot more data.
Yeah, and one other thing that I forgot to mention, what we're looking at here on this page probably represents about 2% of the total tracking portfolio. So that also gives you some perspective. We're not talking about, we would never see a screen like this with a real portfolio in a real investment club. You'd never see this, never get to this.
Yeah, this is a tracking portfolio, folks. Way, 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 way more holdings than a real portfolio would put up. I have a hand in the air right now, Mark, from Nalini Mehta. Nalini, go ahead. What's your question? Nalini, you're unmuted. Okay, it appears to be an inadvertent
Probably.
hand.
Probably experimenting.
I also have a question from Ann Manning. Ann, go ahead. You're unmuted.
Yeah.
I just wanted to make the comment that I agree with what you're doing is trying to find the place to where to sell things. I did bite the bullet this past year and make a purchase of GE with Hughes recommendations. And before I did it, I went back and looked when he was recommended Bank of America, and we all thought he was crazy. Those numbers back then were worse than what GE is right now. So I agree with what you're doing of selling these, but I think that sometimes you just kind of have to hold on and see what comes back around.
Yeah, I agree. That's a great point. Well, I guess I'm inclined to see how it works out and measure it. And there's nothing preventing us from coming back to GE either. Is also something we should all recognize. In fact, I thought about printing Hugh off a coupon to come in with a multi-selection.
Mark, I'm getting a question from 3 or 4 people, and I'll use Herb's wording. This is Herb Barnett out of Pittsburgh, and Herb says, is the list of transactions available for examination? I think, Herb, if you were to write Mark a very nice email and say, could I have this segment of the spreadsheet to take a look at, I think he might send it to you. So drop him an email and see what his response is. Mark, what do you think? Would you send some of this to Herb to look at?
Sure, and I owe everybody following that Turnout Tuesday the spreadsheet for tracking this anyhow. So, yep, not a problem. All right, so I'll go ahead and initiate those transactions. Hang on to the 2 we talked about, and let's see what happens. Like I say, it's a fairly small amount of the portfolio. And last but not least, let's talk about quality degradation. And when the wheels start coming off, these are the companies in the tracking portfolio that are in the good quality range, again, between average quality and excellent quality. And some of them are going up, some of them are going down. The trend and direction is really important here. And I've actually put in limits to flag any further drops in some of these up at the top. But the one that really gets me is Polaris. We've had quite a run with Polaris, and I know you're very close to this one, Ken. It had a substantial recovery, but it seems to have hit the skids a little bit. And here's the chronicle. The price recovery has been awesome here in the last few months, but it's kind of atrophied here in the last couple of months. And the quality is drifting south of 80. Any thoughts on this one?
I moved out of Polaris in 2014, 2015, and I haven't gotten back in. I haven't found a place where I've been comfortable moving back into this particular stock, so I'm not following it real closely, but I am looking at where we have suggested there might be a trigger, and that's when you have a pretty decent drop in quality, and I see it happen there, maybe right in December 2016 or January 2017, and I look at the price afterwards, and actually the price recovered rather than continued on its downward swoon. So this would be a counter example to a sale when the quality has a significant drop. Now, the quality has continued to drop, and it's moved through that 80 number. I don't know if there's anything magic about the 80th percentile or not, and I don't know if that's a big enough quality drop for it to show up on my radar at this particular point. So I'm in a quandary as to what to do with this particular one. I'm not a big believer in reading charts and they tell me the same thing every single time. So I'm viewing Polaris right now as a counter example to what we've been talking about with quality degradation.
Yeah, a little bit. I think it really puts it on. To me, it puts it more on the elevated hot seat. S&P dropped coverage, so that dinged the financial strength a little bit. Anyhow, the quality is down in the mid 70s, maybe low 70s now. I think it might be the sort of thing where we have noticed that you can have 6 to 9 months to actually take action, and maybe you just put it on some type of elevated watch list and watch for any further deterioration. I don't know.
I'd be very interested in seeing the next green bar. I know it's coming up real quick in another 3 days, and seeing where the graph moves to that point. But I don't know if it's telling me very much right now, except that if we were pulling the trigger when quality dropped by 10 quality points or more, not 10 percentage points, but by 10 quality points, if we were pulling the trigger, we would have pulled the trigger back in, March or April, something like that, and then would have lost out on the price. The price at the end of July was still above where it was after the quality dropped. So
yeah, I hear what you're saying. It was still always in the excellent range, though.
yeah.
But so I guess we leave this one and maybe kick it around a month from now, and
Okay.
hopefully they'll sell enough jet skis to be strong for this period of time. And by the way, for those of you listening along, Ken was wondering when was the best time to buy. Right there. Look at that peak in return forecast. The quality was still pretty good. You'd be sitting on a pretty good investment. But that's hindsight. So we'll go ahead and execute those transactions. We've run a little bit long, so we'll try to wrap up our 3 stock presentations here in short order and leave some time for Q&A. But Kim is going to get us underway with Wyndham Hotels, ticker symbol WH. Take it away, Kim.
Kim, we're not hearing anything, so you might be muted.
She snuck away to counter money.
Can you hear me? Oops.
We can hear you now.
Oh, now you can.
Yep.
Okay. I am a fan of spinoffs, and if any of you have been to any of my lectures at convention, this is a spinoff stock. Wyndham Hotels was part of Wyndham Worldwide. Next slide. Wyndham Worldwide announced last year that they were going to have a spinoff, and then in the first of the year, they announced that they were buying La Quinta. So as of June 1st, Wyndham Worldwide spun off into Wyndham Destinations, which is WYND, which is their timeshare area. Wyndham Hotels and Resorts is WH, which I'm presenting tonight, which is their hotel management division. And then with buying the La Quinta, they got the hotel management division of La Quinta, and then they've added the La Quinta Hotels and some other hotels to Core Point Lodging, which is now a REIT. Next slide. If you want to find any of these slides, you go ahead and look on the Wyndham Hotels and Resorts website, because they have it from 5/18. What they say they do really well is license their hotel brands to hotel owners and help them attract guests. They get the hotel properties from third-party owners, and they provide a very good brand at different price points of the economy and midpoint and the higher end of hotels. Their strength is they are the #1 largest hotel franchisor, and they have this super strong portfolio of well-known brands. I'll have a slide later to show you all of those so you can recognize it. They are in the leading position for an attractive economy and mid-scale segments. They have the leading loyalty and technology platforms, and I'll talk about that. They have the ability to create through value through acquisitions, because they consistently have grown with their acquisitions and paid down their debt, and they've got a strong and experienced management team. They have hotels in 6 different continents, 80 countries, 40% of it's international, and we always want a stock that's international, so there you go. Their thesis is asset light fee-based business that drives consistent earnings and cash flow. Now, it sounds counterintuitive, Wyndham Hotels and Resorts, but they only own 2 hotels. They do the back management of the website where you click on, you look at the website to find out which hotel you want to do. They develop the website on your phone for mobile, and they have the most number of hotel rooms compared to anyone. You can see how much there. Next slide. These are the hotels that are within their portfolio. You should recognize a lot of them. Days Inn, Microtel, Super 8 is their #1, and it gives the customer great options, and it builds a large loyalty, and they've got this global distribution of these hotels, so it's worldwide. And they have it at all price points, so that makes it higher contribution to these franchisees for more money. Now, the Hawthorne, which on the second row on the left, that it has had a 23% increase in new hotels because people have liked those hotels so much. The piece of trivia, the Trip on the third row there, they just opened up a brand new hotel, which is a mid to high point hotel in Fort Lauderdale, where I'm at. The Wingate by Wyndham on that third row there, it has been #1 the last 3 years in the mid-scale area. And the Baymont on that second row is the mid-level. When they first bought that brand, they had 100 hotels. Now they have 500. Next slide. Being this leader, they've got a very attractive economy segment, which is 41% of the hotels within the U.S. And the other choice hotels, hospitality, extended stay, and others. So they've got a large variety of hotels for that segment. Next slide. In the mid-scale, 31% of it is in these, and in JD Power ranking, they have the top 4 of 5 leading brands. They have a retention of their franchise base is at least 94%, and they have long-term affiliations with these franchisees of at least 10 to 20 years. And these franchisees may have many different hotels and many different names of the hotels. Next slide. Now, these franchisees are attracted to these brands of the Wyndham because of how their capital is invested. So if you can see this real well, that a franchisee may invest $1.7 million, but the hotel EBITDA gives off $686,000, which gives the franchisees a return of their invested capital of 40%. And how can anybody complain with that? And as those hotels get more and more return on their invested capital or investment, that's because the hotels and resorts are being very supportive to these franchisees with helping them with their marketing, helping them with their backdoor with their websites, as well as with the reservation systems, because every time there's a click on there, those franchisees have to pay to it. So they're very asset light, like they said. Next slide. Now, they have a Wyndham Rewards program, which is like the largest, and they have over 56 million members, and it's been growing rapidly, and you have over 30,000 plus places that you can redeem your points. Now, one of the things that a lot of people say is, why would you have a hotel stock in your portfolio? Because what about Airbnb and all that? Well, they've started a new thing called the Blue Thread, and that's where they are also adding, under the Wyndham Rewards name, hotels and condos so that you could make reservations of those. Next slide. One of the other things in that Wyndham Rewards that they're adding is they've added across their system that if you have 15,000 points, you have no blackout dates, no tiers, and you can have any hotel across their whole system. And the Wall Street Journal had this article saying back to use your points, how beneficial is it for the individual member who are part of that Wyndham Rewards? Well, Wyndham provided back 16.7% of a better payback of their loyalty program compared to Marriott, Hilton, and Starwood and all. So you get the best payback of all by sticking with Wyndham. Next slide. Now they have a long and successful history of buying and growing the hotel brands, and they are able to integrate them quite successfully. And the synergies of American Inn here, that was in 2017, they were able to integrate that and get that done within 6 months. The La Quinta brand that they just added will bolster their mid-scale level hotels, and it's always good to remember they don't want to own any real estate. The franchisee owns the real estate. So they want to grow organically, and they've been doing it, and they're very successful with doing acquisitions. Right now, the growth in their U.S. pipeline is 40% of conversions of one hotel to one of these within their pipeline, and 60% is of new construction. Next slide. We always would like to have a stock in our portfolio that has international growth as well. And I think this is just great to see where they are going to add 13% conversions of current hotels in the pipeline, but 87% of those rooms that are going to be added are of new constructions. And the middle income class is driving the demand. And with driving that demand, Wyndham Hotels is going exactly after that market. And the middle class will double in size within the next, I think it's 5 to 10 years, and 50% of it will be international, and this is exactly what this company is doing. So they've got hotels that they're adding in Asia, Latin America, Europe, India, and all. So next slide. That Wyndham endorsement kind of is a nice big circle of how, if you get high awareness of those iconic brands that you saw there, it increases your connections to the Wyndham Rewards and gives you more quality halo to those economic brands, so it makes you aware. Next slide. One of the things that's been driving their growth is how they've changed their digital platform, and they feel that they are 2 to 3 years ahead of their competitors on how well they've integrated their digital platform and on mobile. And I think that last point there, that mobile room nights have grown 75% year over year. And it has also increased, it has driven over 35% of all direct bookings is by their mobile platform. So that improving that platform has really made them have lots of growth. Next slide. They have an asset-light hospitality business, and it gives you very stable, reoccurring earnings. So I love that term, reoccurring. And if you can see, it's a fee-based income, and 90% of it is fee-for-service. And they have long-term agreements with it, 90% margin on franchise and royalty fees. And their capital expenditures are less than 10% of their adjusted EBITDA. And in doing this, it makes them it's not a capital, it's a cash generating, not a cash consuming company with lots of hard core assets that they have to have there. 80% of that earnings is reoccurring, and that even makes that better. And their EBITDA and revenue growth has been 10 to 12% the last 5 years. So plugging in the numbers from the pro forma into the into the Eagle here, next slide, this is what I got. The presentation said that their annual rates of sales has been 10%. Their net margin actually had in one of the slides as 28%. Share count, there you go. Earnings per share this last quarter was $2.23. Going forward, $4.94 was the estimate. Current PE was at 24.9, and PE forecast going, if we just keep the same at 25, they're your stock price, where the stock price could be forecast. They announced in their presentation that they have a 30% payout ratio that they project, and that would give us an annual return of 18.6%. which is that wonderful triple play. They've got increasing margins. Their PE is consistent, as well as all of a sudden I had a drew blank.
Depressed stock price, Kim.
Depressed stock price because, next slide. I took this off of the E-Trade website. This is what they feel the stock price should be within a year. Average is low of 67, but high of 82. Average price target would be 72.83, which would at least be our 15%. The other thing that is always sweet is Yahoo, just as a confirmation there, had their one-year price target of $70.50. Today, the stock price closed at $56.63. And one of those things that I like to do when I follow the SEC filings, which for me is like a cha-ching moment, is when the insiders want to buy shares and they buy it with their own money. This was presented, and I found it on the website as of August the 6th. Now it's the 28th, so we've almost got 3 weeks ago. The CEO spent his own money and bought 10,000 shares. Now, this was not of a quarterly grant because of anything. He spent his own money, that's $614,000, $824. So he spent at least $500,000 buying stock for himself to add to his portfolio. I'm kind of a greedy person, and if somebody's going to put skin in the game, I like a lot of skin in the game, and $500,000 is where I minimally like to have it look at. You know, if somebody buys $20,000, $30,000 worth of stock, that's like dropping the bucket to these big guys. But $500,000, he's got a lot of skin in the game. So this is the stock I'm presenting tonight. I hope you will give it some consideration. Thank you.
All right. Thanks, Kim. Good stuff. I wasn't aware that Marcus gave up Baymont, but now I know.
Mm-hmm.
All right. Let's keep rolling with Ken with IP Photonics. This is also my pick for tonight. I'll prove it in a minute.
Thanks, Mark. Would you go to my first slide, please? Mark's always picking whatever I say I'm picking. I don't know, Mark. I start my stock selection guides by looking at the Chronicle on the Manifest site, and I want to see for a stock that I'm going to add to a portfolio or I'm going to increase the position, I want to see a quality line that stays consistent or is even moving slightly in the upward direction, and that's that blue line on this kind of busy little graph right there, and you can certainly see that it's moved from maybe around 95 up to 100 in the last 4 or 5 years here. I'm really pleased with that. At the same time, I'm very aware of the fact that at the end of July, which is this graph is showing end of July, the par was almost 14% with a $224 price tag. And today the par is 18.7%, and the par has gone up almost 5 points, and the price has gone down about 25%, down to $168. So my first question was why? I read their earnings call. I looked at their website. I did some deep dives into some research that I am privy to from my broker. And it seems that the only real reason I can point to what's happening is that the company gave some extremely conservative earnings per share guidance for the year 2018 after a bust-out year in 2017. They talked about earnings in the 7 to 8% range, but then they continued to speak about robust growth past the 2018 fiscal year. I don't know what their definition of robust is, but it's probably at least bigger than 7 to 8%. I took that into account. I know the market's been punishing companies that have given weaker guidance or that have disappointed with what the analysts think the earnings should have been. So I'm looking at IPG, which I own, as maybe a stock that was punished a little bit more than it needed to be punished. Next slide, Mark. I then went to their press release for the end of the fiscal year, and right at the top in italicized font was that the charges related to U.S. Tax Cuts and Jobs Act reduced earnings by a diluted number of 90 cents per share. So there was a 90% reduction in earnings during the fourth quarter of the last fiscal year, and it had to do with the new tax law. That's important to me as I try to do my analysis using the GAAP data provided by Morningstar. Next slide, please. I then pulled up my SSG Plus. I threw out an extra line, that's the orange line that you see there. That's net income. Think of that as the income that's left after the company pays its taxes. And that means then that you can read distances between these lines as actual words or quantities. Green to pink, that's expenses. Pink to orange, that's taxes. And orange to blue, that's number of shares. Well, notice from 2016 to 2017, orange to blue stayed relatively consistent. The company was not fooling around with the number of shares. It wasn't reducing or adding shares. Notice that green to pink stayed relatively consistent from 2016 to 17, but pink to orange, that's taxes, went up during the 2017 fiscal year as compared to the 2016 fiscal year. That just verifies what the press release told me in the slide prior. Next slide, Mark. Thank you. I adjusted the data. I went in, I actually adjusted the annual data and the quarterly data to kind of wipe out that 90-cent charge that was taken on the fourth quarter. I adjusted the tax rate and the net profit numbers in the data. Notice that I erased the oldest 3 years. I wanted my trend lines to lie underneath the remaining data as closely as I could get. I think that does a pretty nice job. Those trend lines are practically invisible for some of the quantities right there. And these are the graphs that I based my judgments on then. Next slide. Just a little tiny bit about what IPGP does. They have a really good website with a lot of different presentations. They go out of their way to explain what their company does because it's quite technical. They have, in their own words, revolutionized the laser industry. Lasers used to be based on gases, and they used to be based on mechanics. They are now based on fiber. And you've heard of fiber when it comes to fiber optic network. Well, you can deal with fiber when it comes to lasers as well. Lasers have gone from big cumbersome machines that broke down on a regular basis to fairly small machines that have virtually no maintenance attached to them and don't have a lot of consumables needed to keep the darn thing going to make it happen. So there's just some pictures of the big bulky ones compared to the nice new small ones that IPG has revolutionized the laser industry with. Next slide. Here's the key takeaways from any of the presentations that IPG puts on. You can read as easily as I do, but you can see that they consider themselves the market leader and that they're rapidly growing their earnings and along with their earnings, their cash flow. Next slide, please. The markets for lasers are growing. There's kind of a dual push to help this growth in markets. The first push is the increase in the number of laser-based systems moving away from non-laser machine tools. So that's one place where lasers are increasing in sales. And then the other thing that helps IPG is within the laser category itself is this shift from other laser sources to fiber-based laser sources. And again, IPG is the leader in this field. Next slide, please. You can see that there are significant barriers to entry according to the company. Lots of patents pending, costs which undercut their competitors by as much as 70%, and thousands of lasers being shipped every single quarter. a lot of IP know-how and a lot of vertical integration. Plus, they really have built out the manufacture of these machines so that they operate on a pretty efficient scale. Next slide, please. Global presence all over the world. This is not primarily a U.S. company, although it's based in the United States. They do an awful lot of their sales in Asia, some of their sales in Europe. This slide is kind of busy, and I would urge you to go to the website if you're really interested in what's going on here. But all in all, this is truly a world-class company. Next slide. They feel that there's a lot of room for growth in the laser market. Right now, they feel that it's a $6.5 billion business, of which industrial lasers represents about $2.5 billion. You can see the different applications of lasers off to the graph on the right there. You can see that the total use of lasers is increasing, and it's projected to increase for the next 10 or so, next 5 or so years. And you can see that there's lots of different areas, industrial areas where lasers are going to. Some of the more interesting that I found were the use of lasers in digital cinema and enterprise displays. We're moving to lasers in a lot of advertising and a lot of entertainment. You can read for yourself the other applications. Next slide, please. Here we are at the bottom of the SSG. There's those first 3 older years of data struck from the graph there. Remember, I've adjusted the numbers for the last fiscal year to reflect that one-time repatriation tax charge. So my numbers will not match the raw numbers that you see coming off of the data from Morningstar, but I'm noticing that I'm getting pretty good growth in all 3 of the areas that we measure. And I'm looking at growth that, for all intents and purposes, is very consistent, one to the other, nice parallel lines, and there's my up straight in parallel idea. I've set growth going into the future at about 12% for sales, 12% for earnings. I'm looking at the bottom right there. The only red is in debt, and that debt is really fairly minor. So a little bit of up and down is showing as red, but for the most part, you could say the company carries virtually no debt at all. Next slide. My SSG ends up with being a buy. I used a high average PE of about 25, a low average of about 15.5. I'm getting an upside downside of 4.5 to 1 and a par value of about 11.5. That's really exactly the kind of par I'm looking for a nice medium-sized company. Again, next slide. Here's the eagle from the Manifest website, which I use. This is the stock sheet from the Manifest website, which I use for confirmation of what I'm doing when I'm all finished with my own SSG. I'm noticing that the Manifest par number is 18.7. I'm doing 11.5, so I want to know why I'm below that 18.7. Well, it's pretty easy. I did my study based on a 12% sales growth. Manifest is using 16 plus. Remember, these Manifest numbers are coming from analyst consensus, so I'm very much on the conservative side when it comes to sales growth. I'm also a little bit on the conservative side when it comes to average PE. I was at 20.25. Manifest is using 22. I'm really happy with 11.5%. I'm doubly happy that Manifest is above that because I feel if I've made any errors in this SSG, they probably are in being a little bit too conservative. So if the sales growth goes up above 12, if the PE average is above 20.25, then I'm going to get more par out of the whole thing, and that makes me happy. So I'm going to suggest that we add another position of IPG Photonics to the website.
Good stuff. Thanks, Ken. I believe, in fact, I'm sure of it, IPG is one of our small companies from last year, and it's also been recently featured by Cy Lynch, and one that we're coming to know a little bit better. We do tend to believe it's world class. I'm going to kind of whip through these here fairly quickly. I just wanted to issue a formal invitation to any of you who want to submit small companies that seem to be pretty much up straight and parallel. Here for the next 2 to 3 months, Ken and I will be actively trying to find our list of the 40 best small companies that we publish every year around Halloween, and you're invited to participate. Really quickly, we've had a blast doing this since Forbes discontinued doing it 3 years ago, and we think our results over these last 3 years are actually pretty special. The long-term results from these best small companies in the portfolios that we have tracked is pretty strong, and we look forward to doing it again this year. Some of our favorite sources for these 40 companies, in addition to all of you, come down to the list that you see. We love to mine and prospect in looking over the shoulders of people who seem to know what they're doing, like Brown Small Company, BCSIX, Conestoga, that Prime Cap Odyssey Fund. We mentioned Chris Jenner with Rock Springs earlier with Artilex, one of Hughes' companies that he has selected. But again, just going down the list, looking for people who seem to know what they're doing, including David Gardner, and looking for early stage, rapidly growing companies.
I'm also, Mark, not above grabbing them right out of portfolios that we go over as we travel around the country to different chapters and do portfolio reviews. We found some really good ideas in some of the portfolios that some of our clubs hold throughout the country, and we're not above stealing those ideas and putting them on the list.
Yeah, as Ken and I have demonstrated year in and year out, we are in favor of borrowing good ideas. We all get better together, folks. There's no two ways about it. Here's one of our weekly updates that we provide at Manifest as we go through this process. This was one particularly rewarding week last year as a number of companies came to our attention, and I know that the 3 highlighted there ended up among our top 40 companies. So I'm sure there's some new names on that type of a list to many of us in the room. So with that, let's go to my stuff for tonight. I'll be really quick. I told you earlier I would prove that IPG Photonics was my first choice. I went looking for companies with high growth rates. I wanted a set of companies that had a projected return of 12% or more, excellent quality, in fact, super excellent quality at 90 or better, financial strength of 70 or better. I want those double digit, and I'm going to go at least 12% here tonight. And then in honor of Hugh McManus, I wanted to find some stocks trading near their 52-week low, so have some semblance of value. That's a pretty good list. IPG, like I say, I would have chosen that in a heartbeat. LCI, the company that I am going to choose. Facebook, that could be an interesting debate, but it's there. Booking also makes this list. The old Priceline.com makes the list, and LKQ, one of Herb Lemkool's favorites, makes the list. This is a good list of 5 companies. I could have picked any one of the 5. I went with LCI Industries. Here's why. These guys have been hammered in the last few months. It's a company that makes parts, notoriously or historically, parts for RV, recreational vehicles. That would be Roxy in the background. In the past several months, this company has actually come down 35 or 40% in stock price, even though, and they've had some operational issues, but nothing too monstrous. They're putting new production online. This is the company that can't find enough people down in the Elkhart area. They're issuing hiring bonuses. You guys have all heard this story. They're not limited to just RV parts, and in fact, they look to this year to be the year when they make as much as a third of their total revenue stream from non-RV stuff. So it's not just an RV company. They also supply automotive and other type of fixtures and hardware to non-RV equipment. But you see a company that is in that a little over $2 billion in sales, growing at, again, they've actually had an uptick in expectations as far as the growth rate. Margins have been fairly steady and increasing. There's some concern about that little downdraft that you see in 2017 on the net margin line. And The one area that really shows up in the data as you look across the field of analysts covering the company is everybody's pretty pessimistic compared to Value Line. And that 12 stems from a little bit of pessimism from people like S&P and Morningstar driving that number down. Even with that number driven down to 12 for a forward-looking or a projected average PE ratio, we're still looking at mid-teens projected returns and really decent return forecasts. There's nothing wrong with the company. They're getting better as time goes by. There will be bumps. There's always going to be bumps in an industry that's subject to the whims of the economy like this one, but I'm going to go ahead and accumulate another position in LCII Industries. I think this is one of Kim's picks that's been doing pretty well, even with that downdraft in price. So let's go ahead and add some more. And with that, we are at 9:45. Let's do the poll and keep rolling, Ken.
Okay, I'm going to get myself to the poll here. I do this once a month, folks, so just give me a little bit of time here, okay?
His spelling is often an adventure. He was a math teacher.
I always thought that's why God created spell check for those people like us, or are not number challenged but letter challenged.
I think he just clicks through the spell check.
I couldn't figure out how to get it launched, but now I did it, okay? So I need Len in the back room here to launch my poll for me, all right? We have the 3 stocks we've presented, or you can choose none of the above. I'm watching how many of you have voted. All you have to do is take your mouse and press on one of them. We've been told you can do this on a tablet with a touch screen or on your phone. So don't say you can't vote just because you're not sitting in front of a laptop. Vote, help us out. I'm going to keep chattering until we get to about 85% voting. We just hit 81%, so come on, let's get another dozen people or so voting to push that up to 85.
Even if you're here for the first time, you're welcome to vote.
Okay, yeah. And we hit 85, so I'm kind of counting backwards down to 10 in my mind here. And I think I know what Mark's going to say when I put this closed and when I share the results, okay? So we have a narrow win for IPG Photonics. I think that those two, Wyndham and IPG, are close enough, Mark, to put a holding from the audience on both of them.
Yeah, I called it a tie.
Okay, so let's hide that. Go back to our regular slides, and I think we have one more slide telling people what's coming up. Is that right, Mark?
Yeah, telling people where to go.
He gets a little bit bitter, folks, when he doesn't win these polls, but you know, that's just the way it happens, okay?
Hey, I save on Christmas card.
Our next round table is September 25th. We're running a program in southeastern Michigan, in Troy, Michigan, on October 6th. That'll be Mark and I down there for that program. We're doing a turnout on October 16th, turnout Tuesday, October 16th. Mark will be in the Washington, D.C. area on October 20th. We'll do a roundtable on the 23rd, and I'll be in Charlotte, North Carolina on the 27th. So that's the fall. We're already setting some spring dates. We've noticed that we have a little bit of time in November and January and February. Excuse me, if you're in a chapter looking for a program and you have enough resources to get us down to wherever you are, we'd be glad to come and provide you with some program. We enjoy doing it, and we get nice audiences when we come and visit your chapters. So
we should point out, Ken, that if we're talking January and February, we like them a whole lot better south of the Mason-Dixon line.
Yeah, absolutely. I don't want to go to Minneapolis in February, but we will. We will.
Done that.
Okay, we've done it before, right?
Just a quick footnote on this: that presentation I'm doing for the American Association and the National Association in Washington, that's turning out to be pretty cool. Goes back to Jim Cloonan's book, Investing at Level 3, that we've talked about here over the last couple of years. What I'm going to literally do is take Mr. Cloonan's book and the George Nicholson inspired NAIC Investors Manual, put them side by side, and it's really turning out to be pretty cool. So it's just something for all of you out there to think about. We'll probably do a presentation here online sharing the outcome of that, but I really think the two are very consistent with each other and cover a lot of the stuff that Cy and I talked about this past weekend in Atlanta. We're talking about redefining risk or better understanding risk, but turned out to be a pretty decent thing. So keep your eyes open for an opportunity to check in on that one.
Mark, we do have some questions that I'd like to try to get cleared up. Do you want to do a close now, or do you just want to go into the questions?
Yeah, let's go ahead and we'll go ahead and shut down the recording if I can figure out how to do that. We'll leave the microphone open tonight. I can't see how to actually toggle.
Okay.